Perfect. So starting off the session today with IFRS 15, it's a very important standard, one that is most every paper you should find a question on IFRS 15. It's very, very important here. Starting off here with firstly the number of the standard and the name of the standard. So the number of the standard is IFRS 15. The name is revenue recognition. Okay, so we've got the number and the name. Number is IFRS 15. Name is revenue recognition. As you can see in the box here, number is IFRS 15 and the name is revenue recognition. Okay. So what is IFRS 15? It's basically one rule book all companies should use to record sales. Right? Every company makes sales. To record sales, one rule book. Right? It's one rule book all companies should use to record sales. One rule book all the companies should use to record sales. Okay, one rule book all the companies should use to record sales. Okay, one rule book all the companies should use to record sales. One rule book that is called as IFRS 15. It's a single framework for revenue recognition. What is IFRS 15? It's a single framework for revenue recognition. Okay, it is a single framework for revenue recognition. So if any company wants to record sales, there is one standard that gives the complete guidance on how to record sales, and that's IFRS 15. Next, there's a five-step model on how you should record sales. There is a five-step model. So we'll look into all the five steps in the coming topics. So there's a five-step model, and you must follow the five steps in order to record revenue. What you must do is follow the five steps in order to record revenue. Next, customer contracts. This rule only applies when you sell to a customer, right? This rule only applies when you sell to a customer, right? This rule will only apply when you sell to a customer. Next is consistency, making it easier to compare revenue between different companies. If you follow this standard, it just makes comparability a lot more easier. Following the standard just makes the comparability a lot more easier. If every company follows one standard to record sales, imagine it will become so much more easier to record revenue. If all the companies use one standard to record sales, it will become so much more easier to record revenue. If all the companies use one standard to record sales, it will become so much more easier to record revenue. Next, revenue timing. It tells you exactly when and how much sales to record. Right? Revenue timing. It determines when and how much revenue to recognize. So revenue timing will be an important characteristic of this particular chapter. So this is all pretty much just from a basic understanding of IFRS 15. Next, we look into the five-step process, but first we look into just these ideas here. Firstly, what is revenue recognition? It's basically one rule book that tells us how should companies record sales. Second, there's a five-step model here. You should follow five steps in order to record revenue. Next, this rule only applies when you sell to a customer. Next, it makes it easier to compare revenue between different companies. That it becomes very difficult, easy to compare revenue between different companies, and it tells you exactly when and how much sales to record. It tells you exactly when and how much sales to record. What it does, it tells you exactly how much sales and when to record the sales. So that is a brief about what you will study in the slides to come and everything that there is in this particular chapter. Moving on, we look into the five-step revenue recognition model. Okay, we look into the five-step revenue recognition model. So let's look into that. What is the five-step revenue recognition model? Okay. So firstly, we have to see is five steps. In the first, among the five steps, the first step is identify the contract. What is the first step? The first step is identify the contract. So these are all the five steps here in one slide for you. We will break it down into single and understand all the aspects of each particular step. There's a five-step revenue recognition process. Revenue should always be recognized in five steps. Okay, so these are all the five steps right in front of you. We'll go step by step and we'll understand all the steps. So first we look into the first step here. Okay, we look into the first step here, that is identify the contract. Okay, first step is identify the contract. First of all, what is a contract? The definition of a contract. A contract is basically a legal deal where both the sides have duties. Right? If I talk about a contract is like a legal deal where both the sides have duties. Okay, a legal deal where both the sides have duties. Right? That is the simple definition of a contract. Right? It's like a legal deal where both the parties have some duties. That is a contract. Next, contract forms. It can be written, spoken, right, or implied by business practice. That means it is just how you normally do business. It can be written, it can be oral, or it is just by implied by business practice. There is no certain form that it has to take. It can be written also, a contract can be oral also, a contract can be implied by business practice. Next, legal rights. Both the customer and the company must be legally bound to do their part. If someone gets into a contract, both the parties are legally bounded to do their part. Both the parties are legally bounded to do their part. That if they are bounded by a contract, both the parties are legally bound to do their part, right? Both the parties are legally bound to do their part. Okay, both customer and company must be legally bound to do their part. Both the customer and the company must be legally bound to do their part. Right? Both the customer and the company must be legally bound to do their part. Okay, both the customer and the company both must be legally bound to do their part. Okay, next is the starting point. What about the starting point? You can't record revenue until a real contract exists. For you to start recording revenue, there should be a proper contract in place. Right? You cannot recognize revenue if there is no contract. No contract, no revenue. No contract, no revenue. There has to be a contract. Right? No contract, no revenue. No contract, no revenue. If there is no contract, there is no revenue. Example, your phone plan, you pay monthly, then they give service, right? That's the contract, right? Your mobile phone contract with the service provider, right? Your phone plan, you pay monthly, they give you the service, right? There is a contract, both the parties have duties, right? So firstly, we understood what is a contract. A contract is basically a legal deal where both the sides have duties. Both the sides have duties. That is a contract. Contract can be written, spoken, or just how you do business. It can be implied by business. Both the customer and the company may be legally bound to do their part. And if you don't have a contract, you cannot recognize revenue. Example, your phone plan. You pay the company gives you service, right? There is a contract. Both the parties have a duty. Both the parties have rights, and it's a legal deal between two people. Right? You will pay to the company, they will give you the rights. So they'll give you the phone service. You pay, they'll give you the service. That's it. Okay. Starting point is revenue recognition begins with a valid contract. Legal rights, it creates enforceable obligations for both the parties. Contract forms can be oral, can be written, can be implied by business practice. Okay. Then contract definition, right? An agreement creating an enforceable rights and obligation, that is the contract. It's a legal duty where it's a legal deal where both the parties have duties. That is a contract definition. It can be written, oral, it can be implied by practice. It creates legal rights for both the parties. Starting point, revenue recognition begins with a valid contract. Revenue recognition begins with a valid contract. If there is no contract, there cannot be any revenue. Practical example we've already soon looked into is like a mobile phone. If a mobile phone, you pay to the company, they will give you the service. You pay, they give you the service. You pay, they give you the service. That is identifying the contract. Now, first of all, how do you recognize when there is a contract or not? Right? It's important to know how do you recognize if there's a contract? Right? How do you know if there is a contract? Right? How do you know if there is a contract or not? Okay, now we have clearly understood that if there is a contract, we have clearly understood that if there is a contract, only then there is a, if there is a contract, only then there is a, if there is a contract, only then, only in cases when there is a contract, there will be a, only when there is a contract, there will be a revenue. So now how do you know whether this contract or not? So firstly, approval. Both the sides have agreed and signed. Both the sides are committed to the deal. Both the sides are committed to the deal. That is approval. Both the sides are committed to the deal. Second, rights and payment terms are identifiable. Rights and payment terms are identifiable. We know exactly what each side will give and what they will pay. Right? We know exactly what each side will give and what each will pay. Rights and payments are very clearly identifiable. There's a commercial substance. That means the deal will actually change the company's money in or money out. If they either some money in or there will be some money out. Right? The contract will change the future cash flows of the company. Collectability. We expect that the customer will actually pay us, and we expect that the customer will pay us. Even if one condition is missing, no contract is existent. Right? For a contract to be in place, all the conditions must exist. Right? For a contract to be in place, all the conditions must exist. What are the conditions? Firstly, approval. Both the parties have agreed and committed. We know exactly what each party will give and what they will pay. Commercial substance. The deal will actually change the company's cash flows, what will be in or out in the future. Collectability. We expect the customer will actually pay us. We expect that the customer will actually pay us. And even if one of the conditions are missing, there will not be any contract. And if there's no contract, there will not be any revenue. Right? If there's no contract, there will not be any revenue. So both the parties have approved and they have committed. Rights and payments terms are very clearly identifiable. There's a commercial substance and it will affect the company's future cash flows. The payment is expected to be collected, and if all the criteria must be satisfied before recognizing revenue. For you to recognize revenue, all criteria must be satisfied. All criteria must be satisfied before recognizing revenue. So before you recognize revenue, all the criteria must be satisfied. Right? For you to recognize revenue, all the criteria must be recognized. All the criteria will be recognized, or there will not be any contract. If there's no contract, there will not be any revenue. Okay. This is the 5 criteria for contract recognition. Now we'll go into the step 2. Okay, up till now we finished step 1. Now we'll look into step 2. Step 2 is performance obligation. Okay, step 2 is performance obligation. So let's look into performance obligations. Right, what about performance obligations? How do we understand performance obligations? When we talk about performance obligations, it basically we mean with regards to performance obligations that it clearly identifies the separate promises to customers, right? In the sense that it breaks the contract into separate promises. Okay. Distinct goods and services means in one contract there are separate promises. In one contract there can be multiple promises. In one contract there can be multiple promises. Next there can be multiple obligations. One contract can have many different things to deliver. That one contract can have very different things to deliver. One contract can have very different things to deliver. Okay. Next, customer benefit. Each item should be useful to the customer on its own. Yeah, each item should be useful to the customer on its own. Right? Each item should be useful to the customer on its own. On its own, each item should be useful to the customer. On its own, each item should be useful to the customer. On its own, each item should be useful to the customer. Okay, on its own, each item should be useful to the customer. Okay, on its own, each item should be useful to the customer. That is customer benefit. Second, separate accounting. You treat each promise separately. For revenue, you treat each promise separately. That each promise is treated separately for revenue. Example, car with servicing or textbook with lectures. Right? Car is one obligation, servicing another obligation. Textbook is one obligation, lectures is another obligation. Okay. So performance obligation under this, firstly we look into distinct goods and services. You identify the separate promises to customers. You identify the separate promises to customers. Second, one contract may include several obligations. In one contract, there can be several obligations. Next, customer benefit. Goods and services provide a separate value. Goods and services, they provide a separate value to the customer, and the customer benefits. It's useful to the customer on its own. Next, separate accounting. Each obligation is recognized individually. Example is car with servicing or textbook with lectures. Right? Car with servicing, you can see it on the right. There's a car with servicing. So you can buy the car also and you get the servicing as well. There are two performance obligations for the car company. They'll give you the car also, they'll give you the servicing also. Or educational package. Here you get the lectures as well, and along with that, you get the textbook as well. That is textbook with lectures. You can see the practical examples on the right. Okay, separate accounting. Each obligation is recognized individually. Okay, each obligation is recognized individually. Then customer benefit. Goods and services provide separate value. The goods and the services, they provide separate value. Like multiple organizations, each contract may include several obligations. Not necessarily one contract has one obligations. Each contract can have several obligations. And finally, identify separate promises to the customer. What are distinct goods and services? It breaks the contract into separate promises. In one contract, there can be separate promises. Right? In this example that we have taken, in one contract, there can be separate promises. Okay, inside one contract, there can be separate promises inside one contract. Right? There can be multiple obligations. Customer benefits, goods and services create value. Separate accounting, each obligation is recognized individually. And then examples, car with servicing or textbook with lectures. Next, principal versus agent. Next, we look into is principal versus agent. What about principal? What about agent? So let's look into principal versus agent. So principal is basically you own and control the goods before selling. You take the risk, right? Before selling, you own the goods, you control the goods, and you take the risk, right? Agent is you just connect the buyer and the seller. You don't own it. The person who owns the good is the principal. The person who just connects the buyer and the seller, they are the agent. Okay, the one who just connects the buyer and seller is the agent. The person who owns the good is the principal. Next, gross revenue. Principal records the full selling price, right? The gross revenue, the principal records the total selling price. Net revenue. Agent records only the commission you earn. What does agent record? Agent only records the commission that you earn. Agent only records the commission that you earn. What does the agent record? Agent only records the commission that you earn. Okay, and key test. Who controls the goods? The key test is who controls the goods. that decides principal versus agent. Who controls the goods? Right? The one who controls the good is the principal, the other one is the agent. So if you want to figure out who is the principal, who is the agent, see who controls the good. Okay. So the principal is the one who controls the good, who owns the good. Agent is the one who just makes the buyer and the supplier meet. The agent just makes the buyer and the supplier meet. The principal will record the total selling price, whereas the agent will only record the commission earned. Okay. So here if you look into principal versus agent, what about principal? The principal is the one who controls and owns the good. Agent is the one who just makes the buyer and the supplier meet. Gross revenue, the principal will record the total selling price, whereas net revenue, the agent will only record the commission earned. Right? The best example, if you see Make My Trip and Qatar Airways, if Qatar Airlines if Qatar Airlines sells its tickets via Make My Trip, so Qatar Airlines is the one who owns that ticket. So they are the principal. The Make My Trip only makes the customer and the supplier meet. So Make My Trip is the agent. Okay, Make My Trip is the agent. So Qatar Airways, when a ticket has been sold, Qatar Airways will record the full selling price as its revenue, whereas Make My Trip will only record the commission that it gets. Make My Trip will only record the commission that it gets. Okay, so whenever you want to determine who is the principal, who is the agent, just see who controls the goods, right? Who controls the goods? The one who controls the good is the principal, and the one who just makes the buyer and the seller meet is the agent. One who makes the buyer and the seller meet is just the agent. Okay, one who makes the buyer and the seller meet is just the agent. One who controls the good is the principal. Okay, so we understood principal, we understood agent. One who makes the customer, one who makes the parent, one who makes the principal, buyer and the seller meet is the agent. One who owns the good is the principal. Principal records gross revenue, agent records net revenue. How do you know who's the principal, who's the agent? See who controls the goods. One who controls the goods is the principal. One who controls the goods is the principal. The one who controls the goods is the principal. One who just makes the meat is the agent. One who just makes the two meet is the agent. That is principal versus agent. Next, we look into is determine the transaction price. Next is determine the transaction price. How do you determine the transaction price? Okay. Next, we look into step 3, determining the transaction price. So quickly, once we look into step 1 and step 2, what did we understand? In step 1, we understood that you have to identify the contract, right? And what is a contract? You know, both the parties have some legal duties. It can be written, spoken, or the way the business is conducted. Both the parties have their own rights and their duties. Starting point is basically when there is a contract, only then there can be revenue recognition. No revenue recognition if there is no contract. Example is a mobile service provider. Next, we looked into the second one, performance obligation. Here, what you do is you see in one contract there can be multiple obligations. Like a car, you purchase a car and you get the servicing. So there are two things that the company has to provide you: the car and the servicing. Then lectures and the textbook. So there are two things that has to be provided: the lectures also and the textbook also. That is the example for performance obligation. Principal versus agent, we understood. One who controls the goods is the principal. One who just makes the two parties meet is the agent. Principal records the gross revenue, agent records the net revenue. What are the key tests here? When you want to determine who the principal, who's the agent, just see one who controls the goods. Next, we determine the transaction price. What about the transaction price? Right. Next, we look into determining the transaction price. What about the transaction price? How do you determine the transaction price? So first of all, what do you mean by the transaction price? As well, let's see what do you mean by the transaction price in the most simplistic sense. Transaction price is nothing but the total amount you expect to collect from the customer. The total amount you expect to collect from the customer is called transaction price. The total amount you expect to collect from the customer, how much should the customer pay you for the service that you've given him? The total amount that you expect to collect from the customer is called as the transaction price. Okay, very important. What is the transaction price? Transaction price can change. It includes discount, rebate, bonus, returns. So that is called variable consideration. It includes rebates, bonus, and returns. Right? It includes. So transaction price has to include rebates, bonus, and returns. Next, financing component. If customers pay very late or very early, adjust for the interest effect. Right? If customers pay very late or the customers pay very early, what you should do? If customers pay very late or the customers pay very early, you should adjust for the interest effect. If customers pay very late or customers pay very early, you should adjust for the interest effect. Okay, that is the financing component. In transaction price, there's something called as financing component. That means if there's a lot of time between the transaction date and the payment date, when the transaction happened versus when the money was settled, if there's a lot of gap between transaction date and settlement date, if there's a lot of gap between transaction date and settlement date, if there's a lot of gap between the transaction date and the settlement date, if there's a lot of gap between the transaction date and the settlement date, so you'll have to adjust for this particular delay. For this particular delay, you have to make adjustments. For this particular delay, you'll have to make adjustments. Next is non-cash consideration. If the customer pays with goods or services instead of cash, value those. What is non-cash consideration? Non-cash is customer has not paid you cash, but he's given you any goods or services. That customer has not given you any cash, but he's given you goods or services. Customer has not given you any cash, it's given you goods or services. That if the customer pays with goods or services instead of cash, that if the customer gives you goods or services instead of cash, that is called non-cash consideration. Next, customer incentives. The money you pay to customers reduces your revenue. Now, what is customer incentive? Sometimes if I want a particular supermarket to keep my soft drink. I want a supermarket to keep my soft drink. And what do I want? I want a supermarket to keep my soft drink, but the supermarket guy says I don't have space to keep your drink. So I tell him, you buy a fridge, I will pay for your fridge, and you keep my soft drink. I'll pay for your fridge. You buy a fridge in your shop, you keep the fridge, I'll pay for your fridge. That is called customer incentive. That here the seller is paying to the customer, display his products. So the payments made to the customer, it basically reduces your revenue. The shopkeeper bought the soft drinks, but you paid for the fridge. That reduces your revenue. Non-cash, you're paying in any format other than cash. Financing component, there's a lot of time gap between the transaction date and the settlement date. Variable consideration, it includes rebates, bonus, and returns. That is variable consideration. Transaction price, it is what you expect the customer to pay. The money that you expect the customer to pay is transaction price. The money you expect the customers to pay is called transaction price. The money you expect the customer to pay, transaction price. Variable consideration includes rebate, bonus, and returns. Variable consideration. Financing component. You adjust for significant payment delays. What is financing component? You adjust for significant payment delays. Financing component, what happens is you adjust for significant payment delays. With the transaction date and settlement date, there's a lot of time gap. That is where a financing component comes in. Next, non-cash consideration. Goods or services you receive instead of cash. Instead of cash, you receive goods or services. In exchange, you receive goods and services. That is called non-cash consideration. Next, customer incentives. Payments to customers reduce revenue. Payments to customers, it reduces your revenue. What is customer incentives? Payments to customer reduces revenue. Okay, payments to customers reduce revenue. That is your customer incentives. Your payment to customers reduce revenue. Non-cash consideration, goods or services received instead of cash. Goods or services received instead of cash, non-cash, easy. Customer incentives, payments to customers reduce revenue. Financing component, there's a lot of time gap between the transaction date and the settlement date. Variable consideration, it includes rebate, bonus, and return. Transaction price, expected consideration from the customer. What is transaction price? It is what you expect the customer to pay. And there are four types here. Where the ones that include rebates, bonus, and returns, variable consideration, lot of time gap in between transaction and settlement is financing. Non-cash is when you pay in other than money. Customer incentives is you pay to the customers to reduce revenue. Payment to customers to reduce revenue. That you're paying to customers to reduce revenue. Next, we look into is variable consideration. What about variable consideration? Okay, what about variable consideration? So looking into variable consideration, right? Breaking down all the transactions. Let's just break this down. First, we look into variable consideration. What comes under variable consideration? So when we talk about variable consideration, what we really mean in the most simplistic sense that you get the price isn't fixed. You just can estimate what you'll actually get. Right? In variable consideration, you have to just understand the price isn't fixed. It can change. First is most likely amount. When there are only two options, right? Either you'll get a bonus or you won't get a bonus. Just choose the most likely outcome, right? What is the most likely outcome? Just choose the amount of that outcome. When there are only two outcomes, that either you'll get a bonus, either you don't get a bonus, what is more likely? Just choose that amount. Second, expected value. When there are many options, take the probability weighted average. When there are many options, you just take a weighted average. You just take a probability weighted average. That is expected value. Revenue estimate. Right? You guess the final amount you expect to collect. It's just an estimation. You just guess. Common example: bonus, rebate, discount, returns, refunds. These are some common examples of variable consideration. Reliable measurement. Only record revenue you are pretty sure you will keep. Right? Very important. Only recognize revenue that you're sure you will keep. If there is a certain part of revenue you don't think you're going to get now, you sold it on credit and you don't think they'll pay now. So you sold for 1 million. Now you don't think you'll recover more than 500,000. So you should record only 500,000. So only what you think you can recover, just record that. Only what you think you can recover, just record that. Okay. Next is if there's a significant financing component. Okay. If there's a significant financing component, what happens in that case? Firstly, if the customer pays very late and there's a lot of gap between the transaction date and the settlement date, we say there's a significant financing component, right? And because there's so much time gap, we say there's a delayed payment between when the transaction happened versus when the payment was cleared. There was a lot of time gap. So there's a financing effect. What you should do, you should record the revenue at a discounted amount today, not a future amount. Whenever this is the situation, what you should do, record the revenue at a present value. Whenever this is the situation, record the revenue at present value. Second, discount the recognized finance income over time. Okay, if this is the case, what you also have to do is whatever the finance income, like if you see EMIs work on this, right? That there's a lot of financing component in between. So if you buy something on EMI, so they are earning not only from the sales, they are also earning from the interest income on that, right? The discount received as finance income over time. Next, time value of money. You separate the sale part from the loan part. Time value of money, what happens? You reflect financing separately from revenue. You reflect financing separately from revenue. Time value of money, what do? You reflect financing separately from revenue. Yeah, time value of money, you reflect financing separately from revenue. Next is long-term contract. It happens mostly, right? It happens when long-term contract open happens when payment is deferred over 1 year, that the payment will be made after 1 year. That the payment will be made after 1 year. So what is significant financing component? That between when the transaction took place versus when the transaction actually got settled, there's a lot of time gap. And when there's a lot of time gap, there will be some amount of interest. So what you have to do is you have to recognize that interest income as well, right? So it reflects separately. See, when you buy a 1 lakh iPhone, and you are paying 1 lakh 20 for it because you're paying on EMIs. So Apple is earning two ways. One, it's earning from the price of the phone, 1 lakh, and 20,000 from interest income also. That income it's earning because of time value of money. They say time has some value, right? And if you're paying late, then that value they want to find the monetary value of that particular time that you're taking extra to pay. So they're charging you a little extra because you're taking longer to pay. Okay, so that is called time value of money. It reflects financing separately from revenue. And finally, long-term contracts. It's common when payment is deferred for 1 year. If payment is deferred over 1 year, we say there's a long-term contract. If payment is deferred over 1 year, there's a long-term contract. If payment is deferred over 1 year, there is a long-term contract. Okay, when there is a long-term contract, when payment is deferred over 1 year. When payment is deferred over 1 year, we say this is a long-term contract. That means after 1 year you're making the full payment. It's common in construction. Okay. Now we look into the financing component, the key examples from the financing component. Okay. So what are the key points that we can pick from the financing component? Some examples just to make sense of it. So if we look here, firstly, contract start, right? At the start of the contract, what happens? Goods are delivered before payment. That is the start of a financing component. What happens is you gave the goods first, payment comes later. That is the initial start of a financing component. So what you do is you convert the future payment back to today's value. Whatever you will get in the future, you discount it and bring it to today's value. Use discounting. Then what you do is you recognize revenue at that price, the discounted price, not at the future price. You record it at the discounted price. Next, interest recognition. Keep the recording the interest income until the customer finally pays. You should keep recording the interest income until the customer finally pays. what you should do is keep recording the interest income until the customer finally pays. Okay, so until the customer finally pays, keep recording the interest income. What you should do is you should keep recording the interest income until the customer finally pays. Okay, until the customer finally pays, keep recording the interest income. Okay, until the customer finally pays, keep recording the interest income. Very important. Until the customer finally pays, keep recording the interest income. Okay, interest you should recognize until the payment is received. And finally, IFRS 15 rule, sales revenue and interest income must be separate. Okay, sales revenue and income must be separate. We have a question, guys? Yeah. Mm, mm. So, how you look at it is, yeah, I'm just trying to put it in a way that will just fall into the correct context. So now what happens is that if you are availing the EMI option, right? Like if you're taking the EMI option and you are ending up paying a little extra. So for let's say a £10 purchase, you're ending up paying £13 because you're taking some time to pay. So what they do is your total cost will be £13. So what we do is we discount the extra that you're paying. Ideally, it would have been 10, but because you're taking some time to pay, so the extra is coming down to is 13. So the three extra that you're paying, that is the first of all the interest that you are paying. Why are you paying that interest? Because you're taking some time to pay. So that is the first thing. So there are £10, it's the cost of your mobile phone, £3 is the cost for your interest. That's first thing. So now what you do is accounting wise, now I'll explain you. First conceptually, I just wanted to explain so that you can connect with the concept that if I just purchase a mobile phone, it is £10. If I take some time to pay for the mobile phone, it is costing me £13. So £3 is purely because of the interest. £10 is for the mobile phone. That is the conceptual point. Now coming to the accounting point. So what you do is you take the 13 and you discount it today. So for example, your total payment of £13 you will be making in December. Now is January. So what you do is you take the £13 and you discount it to today. And when you discounted it to today, whatever it comes down to £9, £8, at that amount you will recognize the revenue. At that amount you will recognize your revenue. You record it at a discounted price. And now as slowly time passes, slowly time passes, and then what you do is you increase that £9 slowly over a period of 1 year back to £13. So initially it was decided that you will pay £13, but when you record that transaction today, you cannot record it at £13. You will record it at £9 or £10, whatever the amount being. You will discount that £13 and you will record your revenue at the discounted price. Let me just probably put it here. If there are too many numbers, should not confuse you. So you have £10. ठीक है तो 10 का परचेज प्राइस है and then you have a £3 interest that you're paying. So totally you're ending up paying 13. Okay. So when you will record your transaction, when such a arrangement is in place, what you will do is you will discount this 13 and you will bring it to its present value. This 13, let's assume, is after 1 year. So what you do is you take this 13, you multiply it with a discount factor. You take the 13 and you multiply it with a discount factor. So let's assume your discount factor 0.909. Okay, you multiplied it with a discount factor, whatever it came down to. Let's assume whatever, let's say it came down to 9. So you will record your revenue at 9. Okay, that is the first. Initially, this is what will happen. That initially you will record your revenue at 9. Now, as time is passing by, 1 year has passed by, right? You were supposed to pay after 1 year. So now what has happened as time passes by, you will now increase your revenue as time passes by, and towards the end you will make your revenue as 13. But over the course of the period, this 9 becoming 13, you will recognize this as an interest income. So this 9 has become 13. So you have to show okay, how is this 9 become 13. ये 9 13 कैसे बना? ये 9 13 इसलिए बना क्योंकि 4 की इंटरेस्ट इनकम आ गई. So over the period of 1 year, your revenue goes from 9 to 13, but you make sure that you show the interest income of 4. Okay, so this is how the entire thing spans out. Hmm. 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 आपका कॉस्ट 13 पाउंड है। आपके लिए कॉस्ट 13 पाउंड है। आपके लिए कॉस्ट 13 पाउंड क्यों है? 10 कोई रेलेवेंस नहीं है, क्योंकि यू हैव चोज द ईएमआई ऑप्शन। तो 10 इज टोटली आउट ऑफ द विंडो, right? Had you not chosen the EMI option, 10 was relevant cost. Right now 10 is a totally irrelevant cost for us क्योंकि आपने EMI option choose किया है. So the moment you choose an EMI option, nothing to do with 10. Now the cost is 13. Simple. But you don't record it at 13 immediately. You record it at the present value. And as you increase the present value over time, that increases your interest income. That's it. Okay. So that is about the logic here. Okay. Contract discounting, revenue recognition. Revenue recognition at cash price. So revenue should be recorded at cash selling price. Interest is recognized until the payment is received. And IFRS 15 says you separate the financing from operating revenue. So if you're getting the financing, you have to clearly show it as a separate part of the breakdown of 9 and 4. You have to show it separately. Okay, so that is about this. So what we'll do is we'll quickly look into here. I know it's got a little theoretical, but only the first part is theoretical of this chapter. That is the first 10 slides that we have managed to do. So we'll get a good breakdown of this. Firstly, we understood the introduction here. It's IFRS 15. And then it's a 5-step model to figure out revenue. It's a 5-step model. And we look into all the 5 steps. And customer contracts, it applies to contracts with customers, right? It applies to contract with customers. Consistency, it improves comparability across business. If all the companies are following the same rules, it becomes very comparable. Then revenue timing, it determines when and how much revenue to recognize. So this particular standard gives us all these instructions. There's nothing that is examinable here, at least in these 5 points. It is just about the standard. What does it tell us about? It gives us complete clarity on how to recognize revenue. Next, we look into is identifying the contract. How do you identify a contract? So first of all, what is a contract? Again, both the parties will have some rights and duties. It can be written, it can be spoken, and it can be in whatever way the business carries out. And it gives legal rights to both the parties. The starting point of revenue recognition is the existence of a contract. If no contract, no revenue. Next, coming to how does a contract, how do you identify whether there's a contract or not? First of all, both the parties should have approved. Second, rights and payments are identifiable. You know what each party is going to do and how much each party is going to get paid. There should be a commercial substance that the contract will change the cash flow of the organizations, inflow for one, outflow for the other. Collectability, the payment is expected to be collected. If not, you cannot recognize revenue. 5 condition, all the criteria must be satisfied before recognizing revenue. Before recognizing revenue, all the criteria must be satisfied. Before recognizing revenue, all the criteria must be satisfied before recognizing revenue. If any one of them is not missed there, then you cannot recognize revenue. Next, performance obligations. So within one particular contract, there can be multiple performance obligations. So you have to identify all the performance obligations. Like for example, you buy a car, the company can give you the car also, and it can give you servicing. So the company has two obligations, not just one. Similarly, you can also get the textbook and the lecture. So there are again two obligations here. Okay. So each obligation is recognized individually. Goods and services provide a separate value. One contract may include several obligations. Within one contract, there can be several obligations. Within one contract, there can be several obligations. Okay. Within one contract, there can be several obligations within one contract. There can be several obligations. Within one contract, there can be several obligations. Next, principal versus agent. Principal is the one who owns the particular good. Agent is the one who just makes the uh, contact between the buyer and the seller. Gross revenue and net revenue. Gross revenue is pretty much about the principal recording the total selling price. Net revenue is the commission. The agent only records the commission. The principal records the total selling price. The agent only records the commission. Next, how do you determine the transaction price? First of all, what is the transaction price? The total amount that you expect to collect from the customer is called as the transaction price. Under that, first there's variable consideration. It includes rebates, bonus, and returns. Next, you have a financing component. In the financing component, what happens when there's a lot of time gap between when you get into the transaction versus where you make the payment? There will be an interest element that comes in between. Non-cash consideration, you're paying anything other than cash. Customer incentive, you're paying to the customer to keep your product. Variable consideration, where the most you look into the most likely amount. Variable consideration, if there are only two choices, go for the one that is most likely. If there are multiple choices, then uh, use it's when there are multiple, so you can just take the long-term weighted average in this. Revenue estimate, right? You just take an estimate of a amount of revenue that are expected to earn in the future. Some common examples when we talk about variable consideration, you'll see bonus, rebate, discount. The whole idea is that your revenue is not fixed. That is the meaning of variable consideration. And you can recognize only the expected recoverable revenue. That even though you sold goods worth rupees 10 crore, and if you think you're not gonna get more than 30 lakhs, don't record more than 30 lakhs. It does not depend upon the value of the product sold. It's upon how much you are most likely going to recover from the customer. A significant financing component, when there's a time gap between the transaction date and the settlement date, there's a significant financing component. There's a only happen when there's a delayed payment. So what you should do, first of all, take the present value, recognize the revenue at the discounted amount. Second, interest income. Discount the recognized interest income. The discount should be recognized as a finance income, right? So there's a certain finance income also. Obviously, there's some product income, but there's also the finance income. Time value of money, it reflects financing separately from revenue. Time value of money, it reflects financing separately from revenue. That it gives that breakdown that revenue is separate and your financing income is separate. Then long-term contract. It's common when payment is deferred over 1 year. When the payment is deferred over 1 year, that's called as a long-term contract. This is common when the payment is deferred over 1 year, you are deferring. That kind of a contract is a long-term contract. Example of financing, we understood it starts with there should be a contract, goods delivered before the payment, contract start. Second, discounting, future payment converted to present value. What is discounting? Your future payment is converted to a present value. That is discounting. That you have to take the future payment of $13 and you have to bring it to present value and you record the present value. Then as time passes by, you will increase it and that increase will be your interest income. Okay. The revenue is recorded at the cash selling price. Interest recognition. Your interest should be recognized until the payment is received. The interest should be recognized. The interest will be keep accruing till you made the full payment. IFRS 15 rule, it says keep the financing and the operating revenue separate. Right? Keep the financing from operating, separate the financing and the operating revenue. Okay. So again, follow all the 5-step process in a sequence. Contract assessment, ensure contract meets the recognition criteria. Identify all the distinct promises. Measure expected Measures expected consideration correctly. The transaction price, accurate revenue should only be recognized when the obligation is satisfied. If it's not, don't recognize it. Don't recognize it. Okay. These are some of the theoretical aspects which you need to build on a conceptual perspective so that when the sums come, you can relate it. Okay, when the sums come, you are able to relate to topics. Okay, so obviously at this point we may not have the complete knowledge to finish a exam kit question, but based on whatever we have studied, let's try to test ourselves. And let's get a strong understanding that we'll be able to grab most of the ideas. Okay. Looking at the first one here, yeah. Arpita tried the first one here. Yeah, Arpita, can you hear me? Okay, okay, you're trying to solve it. Okay. I will just bring this. Yeah, best guess? Which one? Okay. So your commercial substance is one of the 5 mandatory things. If not met, the contract does not qualify. So here it's written all the criteria must be satisfied before recognizing revenue. Right? So if they're saying this is not satisfied, you shouldn't recognize revenue. Okay. Let's look into the next one. Yeah. All right. Let's take this one, Nandika. It's here. Performance obligation being distinct. So I'm helping you with this. Okay, capable of being distinct from the context of the criteria to be met. So here they think benefit on its own and separately identifiable. Each obligation is recognized individually, so it has its own benefit on its own, has a separate value. Goods and services provide a separate value and distinct within the context. And they are distinct in its own way. They are separate and they own provide their own value. That's right. Next, yeah, Karan, let's take this one, buddy. Mister. Yeah, which one is it? C. Yeah, C is it? Okay, so a travel website books a hotel room for a customer but does not control the room. Okay, how should the website recognize the revenue? The website does not control the room, right? Who controls? We have studied this. The principal controls the goods. Agent only gets the customer. Okay, which of the following must be excluded when determining the transaction price? Yeah, let's try this one. Yeah, Mukund, let's try this one, buddy. It's related to transaction price. What must be excluded when determining the transaction price? Which one? Sorry, Mukund, I couldn't hear you. One answer. One answer. Which one? B is it? Okay. So you're just saying if you collect anything for third parties, that is not your revenue. That is someone else's revenue. Okay. Like government, you collect tax. That is government's money. We shouldn't recognize it as revenue. Okay. Let's look into the next one here. A tech. Okay. Yeah. Let's take this one here. So, Indrani, have you joined in? Okay. Let's try this one in Indrani. Performance obligation is step two. Okay. The laptop and the subscription are different because the customer benefits from each separately. Okay. Good. Okay. Let's try this one here, Arpita. Yeah. Recognize the gross amount. Absolutely. Okay. Let's take this one here, Nandika. Let's try this. Under step one. So it is identifying a contract, which can ensure that the contract will actually impact the entity's risk or cash flows. It will impact the entities. Absolutely right. Okay, Karan, let's try this one. Again, this is also performance obligation. This is step two. Yeah, which one? A. Okay. Okay. They create a valid expectation for the customer. Implied promises in customary practices can create performance obligation even if they are not explicitly written in the contract. Okay. No worries. Let's take the next one here. Yeah, Indrani, let's try this. Yeah, which one, Indrani? Yeah, best guess. Anybody? Any answer on this? जब ट्रांजैक्शन डेट और पेमेंट डेट के बीच में बहुत टाइम होता है तो उसको हम लोग बोलते हैं there's a significant financing component. Okay, finally, if it is not okay, let's try this one here. Let's take this one, Karan. Absolutely. Very good. No, good. So that is about a good practice. That is pretty much the last part of theory in this chapter. Now it will be pretty much sums, yeah. It's okay. We had to develop a strong base for this, as FA, a lot of us would have not done FA. Okay. So 27 done. Okay, yesterday's videos, I think I'll remove it from YT. I think there were some issues with the sound. Today we will revise the entire chapter 10. Second, we will finish chapter 10 from YT if you have done it already. If not, please finish it. And once you revise chapter 9 and all the TYUs of it and the exam kit questions that we had done yesterday, please chapter 9 because you've just done it, right? It's fresh in your mind. So it's a good time to revise. So revise entire chapter 9, chapter 10, and along with that, we'll do one sum here. So let's do थर्ड में आवाज नहीं आ रही थी फिट को ओके आई थिंक वी हैव डन इट बट एक थोड़ा सा अपने को रेशियोज का रिवीजन हो जाएगा ओके सो लेट्स डू फिट को and also let's finish chapter 10 if you have not you will know where to find it chapter on YT okay try to just do it before me so that once when you're in class you already know what it is and you can ask better questions or you can get your doubts cleared. Okay, so it already the link has been given. Yeah, this really good, helpful. We've got the link. So this is what we look to finish. Finish chapter 10, 9 and 10 are important chapters, guys. Very mostly examined. I would not say every time for foreign currency, but revenue definitely every time. Something has to come from revenue. Okay, so today was a little theoretical, but no problem. We will make sure that we'll finish all the chapter tomorrow and we'll start off with the numerical sums tomorrow itself. I think we can close